For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
Well, podcast time once again. Having fun here off the air with Professor Rick Plum, certified financial planner professional, accredited wealth management advisor. Johnny Dean, your podcast host. You know, you would think, Professor Plum, before we start talking about a topic like this one, which is, Social Security, 5 things you did not know about Social Security. And by you, I don't mean you, Professor Plum, but I mean, people listening, 5 things they didn't know. You would think we'd be discussing that, but you got this down so well that we've spent the last 3 minutes talking about a truly awful movie from our youth, Animal House. So, this just shows to go ya, as they say, that you've got this topic down right now. I mean, usually we do have to do a little prep, talk about this stuff. But
we do?
Well, just, we want to be on the same page. That's all it is. So anyway, that's why I'm chuckling here as we start the show. People have ideas about us. People who know us know it's going to be movie quotes or music. I was saying. Anyway, okay. Welcome to the show. This is Managing Your Financial Future. We are here. So I said Social Security. We talk about Social Security probably 3 or 4 times a year because it's such a big part of people's lives, a big part of people's retirements, and it's a big part of your retirement plan. It's kind of the foundation. Any type of guaranteed payment, which Social Security is part of the foundation of your financial plan. So it does. Any changes or anything like that can affect people to a great degree. But it also helps to know what you're up against. Social Security, Professor Plum, I make fun of the fact that you know everything about Social Security, but that is no small feat because I would say it's one of the most complicated forms of payment.
It's less complicated today than it was 10 years ago when we had more options. But I mean, there's a lot of interaction between the different types of benefits and what you may or may not be eligible for, and it gets confusing.
Yeah, confusing for sure. And the problem is when it's too confusing and you don't have somebody helping you out with it. It could wind up costing you a whole lot of money, and you just don't want to do that. So what we're going to talk about today is 5 things that you did not know about Social Security. I checked. We did something very similar to this a year or so ago, and I wanted to make sure that, first of all, we had people asking us about this, but I wanted to make sure that we don't cover the same things that we did before, because even though it was a year ago. So I'm going to bring up the 5 things that we covered a year ago. And if you want to go back and listen to it, I think it was in May of 2024, you can do so. But the 5 things that we covered about Social Security that you may not know last year were, first of all, Social Security is paid 1 month in arrears. So your October benefits, say, will be paid in November to you. That was one. Another one was that there's no benefits for the month that you died. So if you died and at the end of, say, September, you
don't get a benefit for September.
No, you don't get a benefit. So it's just one of those.
The benefit that was deposited into your checking account in September was for actually August, so you're cool.
Yeah,
you didn't have to pay it back.
Right. So that was another one. Social Security is always potentially taxable. Now, this was a year ago, so as I said, we're potentially not taxing it.
It's still going to be taxable. The bill, the way they're doing the big, beautiful bill, whatever you want to call it, they cannot change the taxation of Social Security through this type of legislature. They have to do a different type of legislature, and I don't know how it is, but based on the Byrd Act, they cannot stop the taxation on Social Security through a budget bill like what they're doing right now.
Okay, so it probably has to be some act of Congress, which is fine. And maybe they'll do that eventually. I am still hoping that's true. Anyway, at that time, Social Security is always potentially taxable. The 4th thing we talked about last time, your ex-spouse may be eligible for benefits on your record And the fifth thing we talked about.
Nothing you can do about it.
No, you cannot do anything about it. Well, fortunately or unfortunately, depending on which side you're on. And the fifth thing we talked about last year was that survivor benefits can be affected by remarriage, and age certainly matters in that case.
Remarriage before 60 can mess up your survivor benefit.
Exactly. So if you'd like to know more about that, I would suggest you go back and listen to that particular podcast. My recollection is that it was around May of 2024. So it was good stuff. And I noticed, too, that as I looked back on these, I can see what comments people have, put on it. And a lot of questions still remain. So I thought, well, let's do this again. Let's do 5 more things that you probably didn't know about your Social Security benefits. And I'm talking about your retirement benefits. We're not really going to get into, we won't get into disability benefits, which is a whole kind of other game. We're going to stick with the retirement benefits. But Professor, I know you're ready. I don't even think I mentioned what these are to you. Maybe I did, but let's start with the first one here. These are in no particular order. But the first thing that you didn't know, or probably didn't know about your Social Security benefits, is that you can undo your claim, but only once, technically.
Right. So let's say you decided to retire at 60, 61, 62, and you decided to take your Social Security right away. But then as you got into it, you realize, you know what, I think I don't want to take, I want to let it grow. I don't need it right now. I want to have more room in my tax bracket to do Roth conversions, whatever the case may be, other things. So I would like to get rid of the Social Security and make it, as if it had not happened. Social Security will allow you to do that as long as you do so within a year of you receiving your first benefit, and you pay back whatever benefits that you have received. So if I, signed up at age 62 and I'm getting $1,500 a month, I'm making up numbers, and 10 months into it, I undo it and I pay them back the $15,000 that I received, then it's going to look like I never applied for it. Now, as John mentioned, that's a one-time, one-and-done thing. If I then decide later that I want to start my benefit and then change my mind again, nope, not going to do it. You cannot change your mind again. You can undo it once. But yeah, so if you decide that you started taking your benefit too early and you make the decision to undo it in a timely manner, under a year, you can pay it all back and rescind your benefit election.
Yeah.
And, start over.
Yeah, and you just kind of mentioned it, but there are people who say, well, why in the world would you do that? Well, there are different reasons that we've seen why people may have done it. They probably needed a little extra cash flow at the time that they applied, but then maybe something happened, they inherited some money. Now, the other thing is...
sometimes also people decide, you know what, I retired and I shouldn't have, and I want to go back to work. I'm bored, whatever the case may be. They go back to work, and they're going to get their Social Security taken away anyway because they're making too much. So they end up saying, well, instead of just having to take away, I'm going to pay back and have it happen as if it never happened.
Yeah.
And then so that makes it a little bit cleaner when you do ultimately apply for it later on when you quit work or whenever you decide to apply for it.
Yeah. And you said going back to work. I don't think we covered that last time or we're going to this time. But as a side note, if you make more than a certain amount of money, and you are under full retirement age, Professor, you gradually and fairly quickly lose your ability to collect that Social Security benefit.
Right. If you're still working, or if you end up going back to work and you're under full retirement age for the whole year, if you make more than in 2025, if you make more than $23,400, you start losing the benefit that you were otherwise getting. How do you lose it? Well, if they look at your year and you made $43,400 instead of $23,400, that's $20,000 over the limit. You would lose $1 for every $2 over the limit. So in that case, you would lose $10,000 of the benefit that you received during 2025. Those are the 2025 numbers. Mm-hmm. How does that happen? Well, they send you a bill and you either pay it back, or when you do become eligible, first off, they're going to stop paying you while you're working until you can prove you're not working. And then when you do become eligible, they're not going to pay you until they've recouped the $10,000 that they overpaid you in that year. Yeah. So it is something to pay attention to, that if you are receiving a Social Security benefit, and it doesn't matter what kind of Social Security benefit. Now, people say, well, what kind of Social Security benefit? There's your own retirement benefit. There's a spousal retirement benefit. There is a family benefit, a survivor's benefit, widow's benefit, widower's benefit. There's a disability benefit. Disability has different income levels than what I just mentioned, so that's a different game. But if you're receiving any benefit under full retirement age and working, you have the potential of losing that benefit. Now, if you lose the benefit and they take it away or you pay it all back, it's as if that portion or that benefit hadn't been paid, so that when you ultimately do become eligible for it again, it won't be treated as being taken early. So there is that going for you. But it is something that catches people by surprise, especially people that retire 60, 61, 62, start receiving their Social Security, and then decide they want to go back to work. And they're making $35,000, $40,000, $50,000. And a year later, they get a notice from the Social Security Administration saying, you owe us money.
Yeah.
I was like,
that's a shock.
And they don't catch you right away.
No.
So my recommendation to you is if you do go back to work, contact Social Security right away and say, I'm starting to work. My income is going to be X. So stop paying me my benefit because I don't want to have to pay you back.
Yeah. And again,
or undo it if you're within a year.
But they give you, as you said, what is it, 23,000?
23.4 for the 25 number.
Yeah. So if you're going back to work part time, and we're talking about W-2 or net Schedule C income. Those are the kind
right.
That's, but if you're going to.
Not exactly the right definition, but basically if you're paying FICA taxes on it or self-employment taxes on it, that's what they're counting.
Right.
Now that's the 23,400 number is for any year that you're under your full retirement age for the whole year. In the year that you reach your full retirement age, whether you reach it in January or December, it doesn't matter. They have a different set of rules. Instead of 23.4, it's 62,160. So a much higher threshold of income before you start losing your benefit. And once you hit that threshold, it's a $1 for $3 over the benefit or over the threshold recoup. So it's a much easier rule to deal with in the year that you reach your full retirement age. And the other nice thing is they don't count the whole year. They only count the months before your full retirement age. In my case, my birthday's in June, so they would only look at the income I make in January through May of the year that I turn 67. That's my full retirement age. To determine whether I exceeded the 63,000. They don't look at the whole year.
So
now some people be looking at that and saying, well, what about if I retire half year? I'm making $200,000, $300,000 a year, and I retire in June, but I want to start receiving my benefits in July. I've already made well over the threshold. And are they going to penalize me because I retired and I didn't do it January 1st? And the answer is no. There is a one-time election to do the income testing on a month-by-month basis. So they look at the months that you're receiving Social Security and the W-2 or other wages that you're receiving in that month. So even if you made $1 million, in the first half of the year, you retired, and then you started receiving your Social Security the second half of the year, as long as you didn't have any earned income that second half of the year, it's okay because they only count the months. Now, this is a one-time election. You can only do it one time, 1 year total. You can't, mix and match years and decide. It's a one-time thing to do it on. Yeah. So, but yeah, it's not going to affect you if you retire mid-year, because in the months that you're retired and receiving your Social Security, you're not making any money.
Yeah, it's a good question that we've gotten, and it makes sense. It makes sense because some people do. They retire in November.
Most people retire at something other than January 1st.
Exactly. So even if you made a ton of money, it's not going to hurt your claim. All right. So those are two that we've done. Two things that you may not have known that you didn't know. First one that we talked about was you can undo your claim, but you can only do it once. And tied into that, your benefits might be withheld if you work while claiming early, meaning claiming before your full retirement age. Good stuff to know. Here's another thing that you may not. I'm kind of surprised that more people don't know this. At least that's been my experience. Your top 35 years of earnings determine your benefit, which is different from, say, a pension normally.
Right. Most pensions look at the top 3 years, the top 1 year. Depending on what your pension's doing, they're saying your final salary, and they they'll calculate it based on that. But the reality is with Social Security, they're going to look at all your years of earnings every year, and from the time you were just a kid, basically. Obviously, probably those won't count because they're very low earnings years. But they're going to add up. They're going to look at all the years. Then they're going to inflation adjust all of the incomes that you received prior to turning age 60. So that $20,000 a year you made when you were 20 doesn't go into the calculation as 20. It probably goes into the calculation at about $80,000 because of cost of living. Well, not cost of living, but inflation over the last 40 years or so that you've been working. They just line it up and they say, okay, it's not the best 35 years in a row. It's just the best 35 years. What were the best 35 inflation adjusted years that you had? And that's what we're going to push into the formula. And if you don't have 35 years worth of earnings, well, they're still going to count 35 years. What they do is they take the best 35, they add it up, and they divide it by 420. Now, if you're not that quick on your math with 12 times tables, that's 35 years in monthly talk. So 420 months is 35 years. And they just calculate and they figure out what your average, and they call it the average indexed monthly earnings, AIME. That is the starting point for determining what your actual benefit is going to be. Now, if you do start taking your benefit at age 67, 68, 69, or at whatever age, and you then keep working. Now you're past the age for the income test, so it's not going to affect your benefit anymore. But for every year that you work, if you're making $150,000 now, and historically you only made about $60,000, that 150 becomes one of your best years. Every year they automatically look, did this last year of earnings become one of your best 35 years of earnings? And they'll recalculate your benefit and send you a higher benefit going forward. And so and that happens automatically. You don't have to request it. So if you do not have, let's say you didn't start working for whatever reason till you were older, maybe you were staying at home raising kids, doing something else, and then went back to work. And so you've only got 20 years in, 25 years in. Well, your benefit's going to be based on 35, but you keep working. Each year adds another year of work. Each year adds another, adds to the bottom line of that AIME. Mm-hmm. Each, that AIME goes up, you get a bigger benefit.
Now keep in mind, Professor, and you know this very well, that, if you're thinking, well, I'd love to increase my benefit, I'm making $150,000, I think maybe I'll just keep working. You are paying the concomitant FICA taxes on that. So,
you're still paying taxes. You're paying Social Security taxes.
Yeah. So I'm not sure that the added benefit would be worth the FICA, or that you'll get it.
You don't work just to increase your benefit. You work to pay the bills today because you enjoy it.
Yeah.
You work, because it gives you a sense of worth, but it also helps that it increases your Social Security benefit.
Yeah, that's all it is. Yeah. So just keep that in mind too. The increase is, not going to be. You're probably not going to make it up. Well,
it's interesting. I know somebody who went through this when they were 71, 72. They were continuing to work and they were making good money. Mm-hmm. And they came to me and they said, Social Security screwed something up, man. They just sent me a check I got a deposit of X, and it was a decent deposit, and my benefit has changed. I said, yeah, you've obviously, they recalculated your benefit and you're getting a bigger benefit for life. And because it happens a year or so later when they get the tax returns and match everything up, they went back and retroactively paid him to the year that he made the money. So he was getting an increase. It was not, nothing. It was, $80-$90 a month.
Wow.
And he got a check for like 13, 14 months of retro. So an extra $100 dollars a month times 1,800 and it comes out. It can help. It can't hurt, and it does happen automatically.
Yeah, and that's a good thing. You don't have to keep track of that. And by the way, when you go on My Social Security, you can look, if you set up an account with them. You can look and see all the way back. I looked, my wife looked, all the way back to whatever your first year of earnings is. Mine went back to 1979. And it'll show you. Now, the number that it shows you is not the inflation indexed number. It is the actual number that
it gives you the actual numbers.
Yeah. So if you're concerned about that and you're trying to add up all the top 35 and divide by 420, you don't have that inflation index formula that they use. But
it's actually, I found it at one point, but it's really hard.
Yeah. Don't try this at home, and I mean that literally. Don't try this at home or anywhere. It's you don't want to let them work it out. But what you do need to make sure when you do look at your Social Security benefits, if you can, make sure that those numbers are all correct. Occasionally, a mistake may happen. Maybe they have a zero where they shouldn't have a zero. Just check. It's a good idea to check to make sure that those numbers are correct. You want to make sure you get the benefit that you are entitled to. So 3 of them down, 3 of the 5. Number 1.
I did find the factors so that, like the income that I earned in 1979 would be increased by 4.8 times. So if I made $10,000, it would go in the books as $48,459.25. But so you can find it, but it really doesn't matter until you've already reached 60 because they don't have all the numbers until you're 60. But yeah, they increase some of these numbers quite a bit.
Oh, they don't have them until you're 60.
But because the inflation, everything prior to age 60. So if I'm not 60 yet, they don't know how much to inflation adjust it yet.
Oh, okay, that's true. I'd forgotten that. So, so we're 3 of the 5. Number 1, you can undo your claim, but only once. Number 2, your benefits can be withheld, or you have to pay back if you work before full retirement age. And your top 35 years of earnings are what determine your Social Security benefit. And there are little sub topics in there, but those are the 3 that we've gotten so far. Another one is here's another one that many people don't know is that you don't get any extra payment for delaying your benefits past age 70. Once you hit age 70, it does not grow. So talk about that for a moment and how it works for the retirement benefit between age 62 and age 70.
Well, in calculating your retirement benefit, they go through the process I talked about before, inflation indexing your income. They come up with that average indexed monthly income, and they take that and they put it through a formula. And that resulting amount is the benefit that you're entitled to as of your full retirement age. Full retirement age is different depending upon what year you were born in. Anybody born in 1960 or later has a full retirement age of 67. If you were born before that, it depends on how much before that you were born. Your retirement age right now is probably anywhere between 66 and 67, but for most people that are getting close to that age or near that age. But it's all a matter of what happens from there. You don't have to retire only. They don't pay you only at your full retirement age. What if I want to retire early? Well, if you retire early, they're going to reduce that full retirement age benefit because they figure you're going to live X amount of years and we're going to pay you the same amount of money over the period of time. So if we pay you a little less, you're still going to get the same amount over the expected life expectancy, basically about age 82, 83. And then also, if you retire later and start receiving benefits later, we're going to give you a little bit more because you don't have as many years to live, but we're going to still pay you the same basic amount of money. So it's spread over fewer years. We're going to give you more money. But they stop increasing your benefit once you turn age 70. So at age 70, the benefit is as big as it's going to get, assuming you don't continue working and adding to your AIME. So it's a matter of if I retire early, I get a reduced amount. I can't retire. I can't start receiving benefits any earlier than 62, but they will reduce it every month all the way down to the 62. Mm-hmm. On the other side, if I apply for and start receiving my benefits late, the last benefit increase, the last delayed retirement credit, what they call it, that is applied is at age 70. Now, you don't have to apply for it at age 70. But you're crazy if you don't, because it doesn't go up anymore. That's the number. Other than cost of living allowances, now you're set in stone. So why wait?
Yeah, there's no benefit for waiting past age 70. Now, I suppose if you forget or whatever, and you say, "Oh, I'm age 70 and a half" or whatever, You can get, what is it, up to 6 months of...
You can go 6 months retroactive, assuming you were eligible for it during those 6 months.
Yeah, so there is that. But just don't delay past age 70 because there's no extra credit for doing so. Good one there. Now, related to this, the fifth thing, all right, that's the fourth thing. You don't get credit for delaying past age 70. The fifth thing that you didn't know about Social Security, most likely, along those lines, is that spousal benefits do not increase if you delay past full retirement age. Professor Plum, this is a little different.
Well, spousal retirement benefits, assuming the spouse's own benefit is smaller than the spousal retirement benefit as well. If you're married to somebody that has a Social Security benefit, you have the potential of getting a benefit from their work record, assuming your benefit isn't very large. At best case scenario, now this gets confusing. It does not matter how old the worker in this example is. I'm going to call them the worker and the spouse. The worker, the only thing that matters is that the worker has started receiving their benefit. It doesn't matter whether the worker started at 62 or 70 or any month in between. The spousal retirement benefit is based on the worker's full retirement age benefit. Doesn't matter. So their full retirement age was, benefit was 2,000, but they're only receiving 1,500 because they took it early. The spousal benefit's still going to be based on the full retirement age benefit. Now, it is reduced if the spouse is under full retirement age when they take it. And it's got a different reduction percentage than the individual's, the worker's reduction. Not too far off, but it's a little bit bigger deduction going down. But on the other side, if they wait to take the spousal retirement benefit, unlike the individual's own, the worker's own benefit that is afforded delayed retirement credits all the way up to age 70, there is no delayed retirement credit for a spousal benefit, for a spousal retirement benefit. So you get no juice. You get no more juice from that orange by waiting for the spousal retirement benefit past full retirement age.
Yeah, there are people who I'm sure have said, "Well, I'm the spouse, and I'm taking a spousal benefit, and my spousal benefit is based on my spouse's full retirement age, which is, let's say, $2,000." And they say, "Well, geez, I'd kind of like to maybe wait. I'm going to continue waiting past my full retirement age. I'm going to go all the way to age 70. Who knows what it'll be then? It must be $3,000 at that point." But no, it doesn't work that way. As Professor Plum just said, they do not increase. So if you're taking a spousal benefit, you're eligible for one, and you want to take one, do not delay beyond your own full retirement age, is what you're saying.
If you can afford to, obviously you still have to wait for the worker to take their own benefits. So if you're married to somebody who's a lot younger than you, you have to wait for them to take it. But on the other hand, it's just one of those things to know that happens, that the spousal retirement benefits there. And this is one of the differences between a current spouse and an ex-spouse, former spouse, divorced former spouse. A current spouse has to wait until the worker applies for their benefit to be able to, for them to be eligible for a spousal benefit, spousal retirement benefit. A former divorced, or I guess they're currently divorced, former spouse does not have to wait for the worker to actually apply for their benefit. They just have to wait for the worker to be eligible to apply for their benefit to be able to get a spousal retirement benefit from that divorced marriage. When you say eligible, you're saying reach age 62. Is that correct? Yeah. Because somebody could be 62 or later.
Somebody could be age 62 making too much money, and they're ineligible technically for their own. But
we've seen it, and the reason they did this, we've seen it. People get very vindictive, and if so you've got a divorced spouse, and you don't want that individual to get any money. You're vindictive. You just want to starve them or something. You can afford to not take your own benefits, and so you wait until age 70. But in the meantime, if this rule was not there, then the divorced spouse couldn't get a benefit either. Mm-hmm. And so you kind of control them at that point. So they took away that control. And so as soon as the divorced worker, as I mentioned in what I was using for terminology, is eligible, whether they apply or don't apply, then, and assuming that the divorced spouse in this case was age 62 or older, they become eligible for a spousal benefit if it's larger than their own.
Yeah, and as I said, we did talk about this on the previous one, but it's important to remind people if you'd like a little more in-depth discussion
Divorce
of that.
benefits are a little bit interesting because they're available out there.
Well, they are, and it's not like a pension. You cannot. You can't include Social Security payments in a divorce decree. I mean, in a pension, a pension, oftentimes you split it.
Well, with the pension, when you get a divorce, a lot of times the pension's a finite number, and it gets split. So if my pension was going to be $4,000 at age 65, but I have to give some of it or some percentage to my spouse, my number goes down. That $4,000 is a finite amount, and it gets split between the two individuals. With a Social Security benefit, that's not the case. My benefit is my benefit, and the spousal benefit is a spousal benefit. And whether my ex-spouse or my current spouse takes a benefit from my work record or not does not affect me in any way, shape, or form. I will still get my benefit. Whether there's one person taking a spousal benefit, nobody taking a spousal benefit, or 3 or 4 ex-spouses that potentially could have applied and been eligible for it, taking a benefit from my work record. My work is my work. My Social Security benefit is my Social Security benefit.
Yeah, and again, if you want to hear more about that, you can listen to our podcast from a year ago. We did get into that quite a bit, and that's one of the things that many people don't know. So the 5, just to go over, to recap, the 5 things that you didn't know. Number 1, you can undo your claim, but only once. Number 2, your benefits can be withheld if you go back to work or are working before full retirement age. Your top 35 years of earnings determine your benefit. You don't get credit for delaying past age 70, and spousal benefits don't increase if you delay past full retirement age. I know there's a lot of information, but I really think that these are the easiest ones to understand, especially the way you've explained them, I think, Professor Plum. Social Security is complex. Everybody's situation is different. Not everybody has to worry about divorced spouses. Not everybody has to worry about spousal benefits. So it's a good idea to know what you're eligible for, and it's a good idea to know, when you do know what you're eligible for, to know how those rules work, because you want to make sure to get the benefit that the full benefit that you're entitled to. Yeah, right. You don't want to take less.
Just a little quick, the average Social Security benefit being paid as of December 2023, the last numbers I could find. What do you think the average benefit across the board, regardless of when you started taking it, just the average benefit being paid? What do you think it was?
Oh man, I'm gonna say $1,900.
Not too far off, and it depends on. It is skewed between men and women. Mm-hmm. For a man, it's $2,100 a month. For a woman, it's $1,700. So on average, you were right there, buddy.
Look at me, I'm average.
What is the maximum? If somebody turned full retirement age this year, 2025, and they had maxed out the prerequisite 35 years worth of benefits at the right time, what's the maximum age 70 or age full retirement age benefit right now? What do you think?
Maximum possible? Oh gosh, it's over full retire. You said full retirement age.
Full retirement.
Okay, I'm going to guess around $3,800.
Not too bad, but it's just over $4,000 if you maxed out enough. Okay. At age 70, for somebody who is hitting age 70 this year and has maxed out the prerequisite, it's a little bit over $5,000. It's right around $5,000 a month.
I remember you said this in another podcast. I remember being surprised at that $5,000 number.
So $5,000 a month is the age 70 max. Basically, it's within a couple bucks, and yet the average is $2,000 a month.
Well, you're saying that's the average payment that's been going out.
The average payment going out right now.
Which tells you
some people are paying less.
Yeah, which tells you that I think many people are taking it early, and they find
the
reason.
Also saying it's really hard to max out those 35 years.
Well,
and what we say by max out is you don't pay Social Security taxes on 100% of your income if you're making really good income. And the benefit is not based on all of your income if you're making high incomes. There's a maximum, there's what they call a wage base. And so in 2025, you pay Social Security taxes on the first $176,100 of earnings that you have. But that number has been going up quite a bit lately. If we go back just 10 years, that number was only 118.5. So only the first 118,500 of your earnings in 2015 were subject to Social Security taxes. But that was also the amount of money that went into the formula. Even if you made $1 million, they don't calculate your benefit based on $1 million in that year. They calculate your benefit as if you earned 118.5 that year, 176.1 this year if you're over that number. So there is a maximum, but so 176.1 is still a pretty good number if you're maxing out. It's not the easiest thing in the world to do, is to max out 35 years worth of earnings.
No, I would say not. Now, if you're 60, let's see, so that means you would have had to be making really good money in your mid to late 20s if you're around 65, maybe age 30. Well, it's possible.
30s.
It's possible. It's possible, but it doesn't happen all that often.
Yeah, so. Because if you want to retire at 67, 35 years takes you back to what, 32? Can I do my math right?
Yeah. Yeah, that's possible. You get some of those, tech workers or Wall Street people, I suppose.
Now, again, though, if you look back to the wage base in 1999 or even 2000, it was only 76,200 back then. So it has gone from 76,200 to 176,100 in 20 years. It's gone up quite a bit.
25 years, Professor. You said
25 years, excuse me. Yes, my math is a little sketchy on that.
Well, that's because we're getting older. We don't know what year it is. We're lucky we know what decade it is.
I don't want it to be 2025.
I don't either. Can we please go back? Just give me a few more extra years. That's all I ask. I hope this was helpful to you. And if you need some extra guidance on this stuff, I mean, we are not the Social Security Administration. I should point that out. But still, you can get help with some of this stuff, especially as it relates to your overall financial plan. Give the folks at Lucia Capital Group a call, 800-644-1150. Professor Rick Plum does a great job making sure that you understand how your Social Security benefits work and to give you potentially the best benefit that you can. 800-644-1150. And you can also go online, luciacap.com, LUCIACAP.com. We do happen to have a Social Security guide. You can download it. Type in Social Security at the luciacap.com search bar up in the upper right. You'll see it. It should be the first thing that comes up. You can download it and read some of that stuff. I honestly think that it may still have the windfall elimination provision stuff.
I was just thinking I'm going to need to take that out of there.
We've been saying this for a while. We haven't done it yet. But it's still good information, okay? You can also get all the updated stuff on estate planning. We have a guide on that. We have a guide on retirement strategies. We have a guide on bucket strategies. So do that. Just go to luciacap.com and download your guide. Let's see. Spotify and Apple Podcasts. Those are the two places you can find this particular podcast. You've already done it because you're listening to it, but if you haven't subscribed, do so. Make sure every episode gets downloaded to your device and listen away. You would have missed this wonderful, wonderful discussion on Social Security, the 5 things you didn't know. Apple Podcasts and Spotify. Professor, we're about out of time, but I do maybe this 5 things. Maybe this will become a trend on this show. I mean, not every week, but I think it's something that's helpful. We could do 5 things about whatever, estate planning, you didn't know. Because there's so many things, so many elements that go into financial planning and things that you know all about that I think maybe we can try that a little bit later on.
Fine with me.
Yeah.
Fine with me.
Yeah, you'll do anything, and that's what I like about you. But I know you got to go, so we're going to let you go. I appreciate that. For Professor Rick Plum, certified financial planner, professional, and accredited wealth management advisor. I'm your podcast host, Johnny Dean. Thanks for listening, Managing Your Financial Future. We will talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice. There's no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you're required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. The information provided is based on current laws which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC.